During the rate spike from 2021 to 2023, multifamily transaction volume fell by roughly 70% as borrowing costs surged and spreads widened. So deals didn't fall apart because the properties got worse. They fell apart because the math stopped working because the debt was so expensive. Welcome back to another episode of the Keeping It Real Estate Show. I'm your co-host, Mike Roeder, and today we're going to be talking about interest rates. It might not sound like the most interesting thing, but I can tell you right now, it is one of the items that impacts the values and the profitability of multifamily real estate the most. So let's dive in and talk a little bit about what's happened over the last couple of years and why interest rates are so critical when you're taking a look at a real estate investment. So again, interest rates aren't the most exciting topic in real estate, but the truth is they can quietly make or break your deal. If you're looking for a property, you can find the perfect property in a perfect submarket, but if the debt doesn't work, the deal's not going to work. And that's why investors need to understand how interest rates affect every stage of a multifamily investment. So let's rewind a little bit here. Back in 2021, average multifamily cap rates were around 4.7%, which again, the cap rate, that's how multifamily is valued. If you're not quite sure what that is, go ahead and jump online, research that. Very easy to understand. And it's a metric that you need to know. But by late 2023, the cap rates had moved into the mid 5% to mid 6% range as interest rates climbed. And that shift alone reduced values by roughly 10 to 20%, even when income stayed the same. So here you have a bunch of properties. You could be doing well on your NOI, whether it's flat or maybe it's rising a little bit, but your values have fallen significantly because the cost to borrow money has increased so much. So this included markets like we were in, Dallas, Nashville, Minnesota, really strong fundamentals, but still we couldn't fully offset the cost of capital rising so quickly, even if we were pushing our NOI or net operating income up. So understanding these dynamics, it's really critical because interest rates influence far more than just the monthly payment on a multifamily or a commercial real estate asset. Interest rates matter because they touch every major lever in real estate. So first, they determine your borrowing costs, pretty obvious, which is often your single largest expense line. Usually you have your mortgage or your loan costs, and then your property taxes right behind that. And when interest rates rise, your monthly debt service goes up and your available loan proceeds, what happens to those? Those usually go down because your lender sizes to what's called a DSCR, your debt service coverage ratio. So basically, if you have, let's say, a required 1.25 DSCR, they're wanting your cash flow after all expenses to be at $1,000. They want your NOI after all of your expenses to be at $125,000. That's the minimum. So if your debt is going up $125,000 compared to the $100,000 debt payment. So if your debt is going up, they're going to require that DSCR coverage ratio to be higher. And so you're going to get less loan proceeds most likely. Second, interest rates drive investor demand. So when rates are low, money is cheaper and buyers flood into the market, which pushes values up. It pushes those cap rates down, which means that the values are higher. Now, when interest rates rise, the opposite happens. Buyers pull back, deals stop penciling, and sellers are forced to adjust expectations. And then finally, interest rates determine refinancing ability. So a property that looked like a home run at a 4% loan may not become refinanceable at a 6 or 7% interest rate if NOI hasn't grown enough. So when the cost of capital changes, everything in real estate changes with it. And one of the biggest ways investors feel interest rate movement is through loan terms. When rates climb, two things happen immediately. Your monthly payment increases, like we've talked about, and then your loan amount shrinks. And a good rule of thumb for this is that a 1% increase in interest rate can reduce loan proceeds by up to 10 to 15%, depending upon the loan structure and the DSCR requirements. So consider a simple example. You have a $10 million loan amortized over 30 years, an interest rate of 4%, produces a monthly payment of roughly $47,000. But if you increase that interest rate to 6%, that monthly payment jumps up to about $60,000. So that's an additional $13,000 of your cash flow every single month that's going out the door. So something you need to pay close attention to. The other thing to consider here is if you're looking at a new acquisition and the interest rate market or environment is really volatile, you might want to build in a bunch of wiggle room, because if interest rates do all of a sudden spike 50 basis points, 100 basis points while you're trying to acquire that project, your loan proceeds might go down significantly. Plus, you have a higher debt payment. So you might be more likely to have to pull out of that deal because interest rates are fluctuating. So pay close attention to what's happening in the interest rate environment. And if it's very volatile, you need to build that into your underwriting as you're going to acquire your property. And then if you're passively investing, make sure that you ask the sponsor or the general partner about this if you're in a volatile interest rate environment. So the next major impact of rising interest rates shows up in valuations. Like we said before, cap rates. Investors price assets based on the spread between the income they expect to earn and the cost of capital required to acquire the property. So when interest rates rise, cap rates generally drift upwards as well, which means your value is going down. And buyers become more cautious, sellers lose negotiating leverage, and valuations decline unless your NOI is growing meaningfully, and if you're able to offset the cap rates going up, which is really tough to do unless you're in a really hot environment or you have a heavy value add deal. So to illustrate, let's say you have a property at a 5% cap rate and it's worth $20 million. That same property at a 6% cap rate would be worth approximately $16.7 million. So there you have a $3.3 million delta just because cap rates have moved on you. So that's why it's so important to tune in to where interest rates are going and where they've been historically. And this played out nationwide in 2022 and 2023, especially in the Sun Belt markets where cap rates have been historically tight. Market psychology is another major piece of the interest rate puzzle. So low interest rates create what many investors call cheap money environments. So buyers flood in, capital is abundant when people are raising capital or on the debt side, and sellers push pricing aggressively because debt is inexpensive. But when interest rates move higher, the psychology shifts almost overnight. So buyers step back, lenders tighten their standards, and underwriting becomes more conservative. During the rate spike from 2021 to 2023, multifamily transaction volume fell by roughly 70% as borrowing costs surged and spreads widened. So deals didn't fall apart because the properties got worse. They fell apart because the math stopped working because the debt was so expensive. And even in excellent markets like Dallas and Nashville, they felt the slowdown, proving that no market is really immune to major rate shocks. Finally, the most painful impact of rising interest rates has been felt by operators who used floating rate bridge debt at the top of the market. Many buyers in 2021 and 2022 underwrote deals expecting to refinance quickly over the next 12 months, 24 months or so. And they were assuming that rates were going to stay low during that time frame. But when SOFR skyrocketed, which is basically the interest rate environment, from near zero to more than 5% in just 18 months, monthly payments doubled or even tripled for many operators. So here you have operators that have put short-term debt that needs to be refinanced, or a property that needs to be sold in a short period of time, and you have interest rates that have ramped up so they can't refinance because they have to bring so much capital to the table, and they can't necessarily sell either because the values have come down because cap rates have went up because the interest rates went up. So that's a really tricky environment to navigate through if you did buy with short-term debt. One thing that we do is we either artificially fix the rate on our multifamily deals, or we buy with fixed rate loans with at least 5 to 7 years of term. For us, 95 to 100% of the time, we're buying with fixed rate leverage just to mitigate ourselves from risk, from interest rate risk. We don't know exactly what's going to happen with inflation in the future. We don't know exactly what's going to happen with interest rates. Sure, we think that interest rates are going to continue to drive downward in 2026, 2027, 2028, but there's not 100% certainty of that. So we would rather mitigate risk and be ultra certain on our exact debt payments, the highest expense that we have, rather than take the gamble, put a short-term loan on the property, hoping that we're going to be able to refinance in the near future, or that we have a variable rate and the interest rate is going to go down. So let's talk a little bit about rate caps. So rate caps is a way to artificially fix your variable rate loan on a multifamily asset. So say you buy you secure debt that has a variable rate, so the interest rate goes up and down. You can buy what's called a rate cap, so it caps the amount of interest that your interest rate can go up to. But the issue with that is many times people are putting in 1-year rate caps. So they'll buy a rate cap and then a year later they have to buy another one. And those rate caps can fluctuate very, very heavily in how much they cost as well. We saw rate caps go from, we bought a rate cap on a 400 unit property for, I believe it was about $40,000. And this was before interest rates skyrocketed. A few years later, we were looking at buying another rate cap. And luckily we did an extended term on that rate cap for about 3 years. A few years later, that rate cap was around $800,000 to buy the same term, same strike rate cap. And the great thing is you can sell those rate caps. So the value of our rate cap went up. So we actually increased the value of that rate cap. The downfall is if you're, in a situation where you have a variable rate loan and you need to buy a rate cap and you buy a short-term rate cap, and the pricing of the rate caps go up substantially, all of a sudden you're sitting 12 months from the time that you purchase the property, you're maybe expecting to spend $50,000 or $100,000 on the new rate cap. And it might be $300,000, $400,000, $500,000 because interest rates have went up significantly. So it can really put some people in a really tight spot. If you're taking a look at assets, we always highly recommend trying to fix your debt or buy a longer term rate cap more than you expect, because you just don't know what the interest rate environment is going to do. So let's talk a little bit about what investors should do. So first, always stress test your underwriting. Model interest rates 100 to 200 basis points higher than your base case and make sure the deal still works. So that's specifically if you're buying a variable rate interest rate debt instrument on the property. But even if you're fixing your debt, you want to make sure that you're able to weather the storm over the next 5 years, 7 years, if interest rates do go up. So make sure to stress test that. And next, understand the loan structure you're choosing. So the difference between fixed and floating debt, bridge versus agency, how rate caps work, how floors work, how the amortization schedule affects the long-term performance, what interest only looks like. You need to understand the debt aspect of your deal, and then match your debt to your business plan. Short-term value add projects often can't absorb floating rate volatility unless NOI growth is extremely strong. Keep that in mind. And then finally, follow the indicators that signal where debt costs may be headed long before they show up in the lender quotas. And then match your debt to your business plan. Short-term value add projects often can't absorb floating rate volatility unless your NOI growth is extremely strong. And then finally, follow the indicators that signal where debt costs may be headed long before they show up in lender quotes. Pay attention to the Federal Reserve meeting notes, Treasury yields, forward yield curves, and agency lender reports. All of these are important pieces. And then again, just stress test beyond what those reports and what those experts are saying, because they certainly can be wrong. Small changes in these indications often foreshadow major shifts in mortgage pricing. So interest rates may not be a flashy topic, but they quietly determine the success or failure of multifamily investments. And the best investors don't try to guess where rates are going. They prepare for the unexpected. Very, very crucial. And by building conservative assumptions, protecting your downside with smart debt strategy, and staying aware of the interest rate environment you're investing in, you're giving yourself an advantage that most buyers overlooked. Respecting interest rate risk isn't just good practice, it's essential to long-term success. And one more thing that I wanted to leave you on. When you're stress testing or when you're taking a look at a new deal, take a look at multiple different avenues. So what would this deal look like with a variable rate loan? What would it look like if I artificially fix the interest rate with an interest rate cap for, let's say, 3, 4, 5 years? It's going to be a higher upfront cost, but you would have, artificially fixed the rate. What does it look like with a fixed rate loan for a 5-year term, for a 7-year term, for a 10-year term? You're going to have different interest rates for each of those different scenarios. So take a look at multiple different analyzers, multiple different ways of looking at the deal, and find out what works best for your risk appetite. And not only that, what works best for the returns that you're looking to get on this deal. So thanks again for tuning in to another episode of Keeping It Real Estate. Please leave us a rating and review on iTunes or Spotify or wherever you're listening to this. This helps us bring out new episodes like this every single week. So thanks so much for tuning in, and have a great rest of your week.